We've all heard the whispers, the shouts, even about inflation. The remedy, inflation hedging. But what if the cure carries its own set of ailments? What if the shield we raise against the storm is riddled with unseen cracks? Inflation hedging, at its core, is meant to be our financial raincoat, protecting our portfolios from the corrosive effects of rising prices. It's the promise of stability in a world where the value of our money seems to be constantly eroding. But here's where the comfortable narrative begins to unravel. We often fall into the trap of believing that all inflation hedges are created equal, that any port in a storm will do. This simply isn't true. Many assume that because something is labeled an inflation hedge, it inherently works as one across all economic climates. This is a dangerous oversimplification, like believing that every medicine, regardless of its ingredients or dosage, will cure the same illness. There are shadows lurking within these supposed safe havens, hidden risks that can undermine your strategy and leave you more vulnerable than before. These risks are not always obvious. They're often buried beneath layers of market hype, historical averages, and well-intentioned, but ultimately flawed, assumptions. In this video, we're not interested in surface-level solutions. We're diving deep, armed with data and a healthy dose of skepticism, to expose these hidden risks. We will explore the potential pitfalls that many investors overlook, providing you with a framework to critically evaluate whether an inflation hedge is truly serving its purpose. Think of it like this: inspired by Warren Buffett's wisdom, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. The same principle applies to inflation hedges. A high-quality hedge, one that you understand intimately, even if it seems a bit pricey, is far superior to a seemingly cheap option riddled with hidden dangers. Because in the world of investing, as in life, true value lies not just in the price tag, but in the enduring quality and resilience of what you hold. Are you ready to challenge the consensus, find your edge, and uncover the hidden truths behind wealth accumulation? Let's pull back the curtain on our first hidden risk, the illusion of inflation beta. What is it? In simple terms, it's the measure of how much an asset tends to move in response to changes in inflation. Certain assets, like some commodities, might show a positive correlation with inflation, sometimes. The danger arises when we mistake correlation for causation, and, even more critically, when we assume this correlation is constant. Data often reveals a disturbing truth. Many so-called inflation hedges are, in reality, more closely tethered to the overall market's mood swings than to the cold, hard reality of rising prices. They become mere proxies for general market sentiment, rising when optimism reigns and falling when fear takes hold, regardless of what inflation is actually doing. Relying solely on inflation beta is like navigating by a faulty compass. It can lull you into a false sense of security, leaving you exposed when stagflation strikes or when inflation surges unexpectedly, defying historical patterns. So, how do we cut through the noise? We need to stress test our hedges. Don't just look at how an asset performed during periods of rising prices. Scrutinize its behavior during periods of high and unexpected inflation. How did it fare during the oil shocks of the 1970s or other periods of economic turmoil? This is where true resilience is revealed. Imagine a life raft that's not independent, but instead chained to a sinking ship. That's the peril of relying on hedges that are ultimately correlated with broader market downturns. When the storm hits, they offer no true refuge because they are dragged down with everything else. Is your inflation hedge truly seaworthy, or is it just another piece of driftwood in a turbulent sea? Let's now confront the second hidden risk, the liquidity trap lurking within tangible assets, real estate, art, collectibles. They beckon with the promise of intrinsic value, a solid foundation in a world of fleeting digital numbers. They whisper of stability, a haven against the storm of inflation, but these sirens can be deceiving. History is replete with examples of these assets becoming stubbornly illiquid precisely when you need them most. During economic downturns, when financial stress tightens its grip, the market for these treasures can simply vanish. Buyers disappear, prices plummet, and the promised refuge transforms into a gilded cage. Imagine being forced to sell your prized possessions during a fire sale. The returns you thought were locked in by inflation protection evaporate as you're forced to accept pennies on the dollar. The very hedge designed to protect your wealth becomes the instrument of its destruction. How do we avoid this trap? By building a liquidity buffer. Maintaining a portion of your portfolio in highly liquid assets, cash, easily tradable securities, provides a crucial safety net. This cushion allows you to weather the storm without being forced to liquidate your illiquid hedges at distressed prices. Think of it as an emergency exit that's bolted shut during a fire. What good is a safe room if you can't escape when the flames are closing in? Liquidity is not merely a convenience, it's a lifeline. Is your portfolio prepared for the unexpected, or are you relying on an escape route that may be blocked when you need it most? Let's now address the third, often insidious, risk, real yield erosion. We can easily become fixated on the idea of simply matching inflation, neglecting to consider the real return. What's left after inflation takes its bite? Real yield reveals the true story. It's the actual return you're earning, adjusted for the corrosive effect of inflation. Data reveals that many inflation-linked securities, like TIPS, offer surprisingly low and sometimes even negative real yields, especially when interest rates are suppressed. You might be keeping pace with rising prices, but you're not actually growing your wealth, and the erosion doesn't stop there. Taxes and transaction costs further diminish your returns, leaving you with even less purchasing power than you anticipated. The hedge that promised protection becomes a costly exercise in simply treading water. We need to adopt a total return framework. Don't solely focus on inflation protection. Consider the potential for capital appreciation. Can this asset actually grow in value, independent of inflation? Look beyond the immediate hedge and consider the long-term potential for wealth creation. Imagine a leaky bucket. You're diligently filling it with water, representing your investment. But the higher inflation rises, the faster the water, your real value, drains away through the holes. If your hedge isn't truly watertight, you'll be left with an empty vessel, despite your best efforts. Are you truly gaining ground, or are you simply running in place on an ever-accelerating treadmill? Let's now turn inward and confront a more subtle, yet equally dangerous risk: the cognitive bias blind spot. It's easy to fall in love with an idea, to become convinced that our chosen path is the right one. But when it comes to inflation hedging, this love can blind us to reality. Confirmation bias whispers in our ear, urging us to selectively focus on data that confirms our beliefs, while conveniently ignoring contradictory evidence. We cherry-pick the facts that support our chosen hedge, dismissing any signs of weakness or ineffectiveness. Anchoring bias causes us to fixate on the initial perceived value of an asset, blinding us to changes in its inflation hedging effectiveness. We become anchored to the past, overlooking the evolving dynamics of the market, and loss aversion makes us hesitant to sell underperforming hedges. Even when the data screams that they are no longer serving their purpose, we cling to hope, even as our wealth erodes. How do we combat these biases? By playing devil's advocate. Actively seek out arguments against your chosen hedges. Challenge your own assumptions. Force yourself to confront the potential weaknesses in your strategy. Consider the tale of the investor who clung to gold as an inflation hedge long after its correlation with inflation had broken down. Blinded by past performance and personal conviction, they ignored the data and suffered the consequences. Is your conviction based on data-driven analysis, or are you simply hoping for the best while your portfolio silently bleeds? Don't just hope for a hedge. Have one backed by evidence and a clear, unbiased understanding of the market. Let's move beyond intuition and gut feeling and embrace a data-driven approach. How do we truly quantify the unseen risks and build a portfolio that is genuinely resilient to inflation? The answer lies in creating a hedge effectiveness score. This isn't about blindly following formulas. It's about building a multi-factor model tailored to your individual needs. We need to incorporate factors like inflation beta, liquidity, real yield, and historical performance during inflation shocks. The key is to weight these factors based on your individual risk tolerance and investment objectives. Are you a conservative investor prioritizing capital preservation? Then liquidity and proven performance during past crises should carry more weight. Are you seeking higher returns and willing to accept more risk? Then inflation beta and potential for capital appreciation might be more important. Imagine building a house without a blueprint, relying solely on intuition and guesswork. That's akin to constructing an inflation-hedged portfolio without a data-driven framework. The complexities of the market demand a more rigorous approach. By calculating your own hedge effectiveness score, you gain the power to compare different inflation hedges objectively. You can then construct a diversified portfolio that is truly resilient, not just in theory, but in practice. Are you ready to move beyond hope and embrace the power of data-driven decision-making? We've journeyed together through the often murky waters of inflation hedging, exposing the hidden risks that lie beneath the surface. We've seen how the inflation beta mirage can lead us astray, how the liquidity trap in tangible assets can ensnare us, and how real yield erosion can silently undermine our efforts. The key takeaway: don't be swayed by simplistic correlations or fleeting headlines. True inflation protection demands a data-driven approach, a willingness to dig deeper, and a commitment to understanding the full range of risks and potential returns. Remember the hedge effectiveness score. Use it as your compass, your guide, your tool for navigating the complexities of the market. Evaluate your own portfolio with a critical eye and make informed decisions based on evidence, not emotion. Challenge the consensus, find your edge, and uncover the hidden truths behind wealth accumulation. Don't just invest, understand the why behind every every decision. Because in the world of finance, as in life, knowledge is power. Inspired by Benjamin Graham's timeless wisdom, the intelligent investor is a realist who sells to optimists and buys from pessimists. Apply this to inflation hedging. Be skeptical of overhyped solutions and seek opportunities when others are fearful. Are you ready to embrace the data-driven path, to move beyond the superficial and discover the true resilience that lies within a well-informed, strategically constructed portfolio? The journey to financial mastery is a continuous one.